Hey, how's it going, guys? Welcome back to the Module 4 of Options Trading's Foundation, the complete options trading course for beginners. Module 4 is all about the advanced options trading strategies that are suitable for beginners. In this video, the submodule 4.3, the strategy we'll be discussing is called the backspread. It is actually one of the most commonly used strategies among those hedge fund managers. It looks a little bit similar to the spread strategies we talked about back in Module 3, but it definitely requires a higher understanding on the functions of options and as well as the market price actions to trade backspread. Alright, let's get started. So, what is a backspread in options trading? The backspread is the option trading strategy that is designed to profit from those market trend reversals with the potential increase in the implied volatility and at the same time to avoid overpaying the options premium. There are two major types of backspread trade setups. First is called the call ratio backspread. It is considered a bullish trend reversal setup, meaning you believe the market will turn bullish and then reverse to the upside. For call ratio backspread, traders buy a greater number of out-of-the-money call options with lower premium and sell a lesser number of in-the-money call options with higher premium, so that the premiums can cancel each other out. The typical ratio between buy and sell of those call options are 2-to-1, 3-to-2, or 3-to-1. The other type, we have the put ratio backspread. It is a bearish trend reversal setup, which means you believe the market will crash and reverse to the downside. For a put ratio backspread, traders buy a greater number of the out-of-the-money put options with lower premium and sell a lesser number of in-the-money put options with higher premium, so that the premium can cancel each other out and you can lower down the cost for your trade in that way. The typical ratios are the same as the call ratio backspread, and I will go through both of these type of backspread strategies with much more details in this tutorial. Alright, now let's start with the call ratio backspread. The best time to use a call ratio backspread is when you are bullish on a stock and anticipate this stock will have a trend reversal to the upside with strong bullish moves and increased volatility in the near future. The beauty of using a backspread trade is that you are taking advantage of the premium differences between the in-the-money options and out-of-the-money options. You are using higher premium in-the-money calls to finance the low premium out-of-the-money calls. In this way, you can dramatically reduce your risk of betting on the potential trend reversals. The best time to set up a call ratio backspread is when the market is near the end of the low volatility consolidation period and the volatility is about to spike up. It usually happens at the end of a downtrend. I will use 2-to-1 ratio to show you guys how to construct a call ratio backspread trade. There will be two trade legs. First, you buy two out-of-the-money call options with lower premium, and second, you sell one in-the-money call options with a higher premium. So basically, with these two trade legs, you are now creating both debit and credit for your account. And ideally, you want the initial credit from your second trade leg to cover the debit in your first trade leg. Sometimes it may not perfectly cover, but it will still dramatically reduce your cost and risk. Only call options are involved, no put options. All the call options need to have the same expiration date. Cool, let's do a quick case study and see how exactly the call ratio spread works in the real trading. Wells Fargo is currently traded at $20 per share in October 2020. The stock has been consolidating in the recent downtrend since August and with pretty low volatility. You believe right now is close to the end of the downtrend, and you'd expect the stock will have a major bullish trend reversal to the upside with a volatility spike by the end of 2020. Also, you notice that the Wells Fargo's in-the-money December call options are priced way much higher than those out-of-the-money December calls. You want to take advantage of this short-term trend reversal, but you don't want to take too much risk on this trade because betting on trend reversal is usually a low probability risky bet. Is there any way you can risk small but still win big? If you know how to trade options, then you will know the answer is yes. The best way to profit from such market opportunities is to use call ratio backspread, and this is how it works. First, you buy two of Wells Fargo's December 2020 call options at a $21 strike with the premium of $1.8 per contract. Second, you sell one December 2020 call options at an $18 strike with the premium of $5.4 per contract. So after you complete this call ratio backspread trade, you will actually have a net credit of $180 instead of a net debit, because the premium you sold from your second trade leg is actually higher than the premium you paid in your first trade leg. But that doesn't mean you won't have any risk for this trade. Your maximum risk is the difference of those two strike prices multiplied by 100 and minus the net credit. After the calculation, we can get the maximum risk for this trade is $120. Your maximum reward will be unlimited to the upside. You will have two break-even prices for this trade. First, your upper break-even price would be the number of the call options you have shorted multiplied by the differences in the strike. Then, plus your higher strike price. And finally, minus the net credit divided by 100. After the calculation, we can get the upper break-even price is $22.2. Your lower break-even price would be your net credit divided by 100 and then divided by the number of calls you have shorted and finally plus the lower strike price. And then after the calculation, we can get the lower break-even price is $19.8. Alright, once we have all these numbers, we can now draw the risk graph for this call ratio backspread trade. So this is how the P&L line looks like for a call ratio backspread trade in general. For this case, we have the higher strike at the 21 and the lower strike at the 18. Then we have the upper break-even price at the $22.2 and the lower break-even price at the $19.8. So as we can see from this chart, there are two different profit zones for a call ratio backspread trade. When the underlying stop price moves above the upper break-even price or moves below the lower break-even price, your trade will be in profits. On the upside, your profit will be unlimited. On the downside, you can reach the maximum profits of $180 if the stock price closes below the lowest strike by the expiration. However, on the other hand, if the stock price is stuck between the two break-even prices, then your trade will be in losses. If the price closes exactly at your higher strike price, then this trade will hit the maximum loss of $120. Alright, so this is the risk graph for our call ratio backspread trade. One thing I do want to highlight here is that because in this case study the premium of the in-the-money call option is high enough to create an initial credit for this trade, there will be cases where you will have an initial debit instead of credit when you complete the trade. Then in those cases, the downside of your risk graph will be in losses instead of the profit zone, but it will not be as low as your maximum risk. The shape will still look the same. Cool, now let's move on to the put ratio backspread. The best time to use a put ratio backspread is when you are bearish on a stock and anticipate it will have a trend reversal to the downside, with strong bearish moves and increased volatility in the near future. Put ratio backspread is very similar to the call ratio backspread. It's just to the opposite direction. However, there's one extremely important different application I would like to highlight here is that the put ratio backspread is one of the major hedging strategies among hedge fund managers and institutional investors. And now let me give you a quick example to show you exactly how you can use a put ratio backspread to hedge your long-term stock positions like a hedge fund manager. Starbucks is one of your biggest positions in your long-term investment portfolio, and it's currently traded at $85 per share in October 2020. The stock had a tremendous bull run for the past few months. You're sitting on a pretty good profits on a Starbucks position, but you're worried this stock might crash in the near future. Starbucks' 50-day moving average is around $80. You believe that will be the strong short-term support level for this stock, and you're looking for some ways to hedge this position if the stock price breaks below the 50-day moving average within the next 3 months. Then the best way to do it is to use a put ratio backspread, and this is how it works. First, you buy 2 of Starbucks January 2021 put options at $84 strike with a premium of $1.9 per contract. Then simultaneously, you sell 1 January 2021 put option at $87 strike at the premium of $5.1 per contract. So after this trade, you will have a net credit of $120 that goes into your account. Your maximum risk will be $180 and your maximum reward will be unlimited to the downside. Similar to call ratio backspread, your put ratio backspread also has 2 break-even prices. After the calculation, we can get the upper break-even price is $85.8 and the lower break-even price is $79.8, which is extremely close to the 50-day moving average price. And that is why we choose $84 and $87 as the strike prices for our 2 trade legs. The combination of these two plus their premium prices can give us the lower break-even price that is extremely close to the key support level, which is the 50-day moving average. Alright, now let's take a look at the risk graph for this put ratio backspread trade. First, we have a lower strike at 84 and a higher strike at 87. Then we have the upper break-even price at $85.8 and the lower break-even price at $79.8. So for this trade, if the stock price breaks the market support level and then moves below the 50-day moving average, which is your lower break-even price, then your trade will be in profits. The lower the stock price goes, the more profits you will be making out of this trade. And that profit will offset the losses you will have on your long-term stock position. Works as a perfect hedge. If the stock price is stuck between those 2 break-even prices, your trade will be in losses, but that means your long-term stock position will be safe. If the stock price doesn't crash and it actually goes up to above the upper break-even price, both of your backspread hedging trade and the stock position will make money. The profit of your hedging trade on the upside will be capped at $120. So as we can see from this risk graph, the beauty of using a put ratio backspread to hedge your long-term stock position is that not only can help investors dramatically reduce the cost and the risk of taking up a hedging trade, it's kind of like you're buying a premium insurance policy with a huge discount. But also, it allows investors to even make some profits on the upside if the stock doesn't actually crash and go down. Because usually for the traditional long put option hedge, if the stock price goes up, you will lose the premium you paid for that put option. But a put ratio backspread can actually let investors to profit on the upside while at the same time protect the downside as a hedge. And that is why you often see a lot of sophisticated hedge funds use backspread to hedge some of their long-term stock positions. Alright, that will be the end of this video on the backspread option strategy. In the next video, we'll move on to the very last sub-module of this entire course and share with you guys the final option strategy that every beginner option trader should know. If you are new to this channel, my name is Vic. I hope you guys enjoying the course so far. If you find my contents have been valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I'll see you guys in the next one. Bye for now.